Good afternoon, traders, and welcome to the nthezone daily ACD recap for Monday, June 13th, 2016. In these recap videos, I go over the best ACD setups for this day. These videos are intended to show you the types of trades the ACD method offers on a daily basis. Let's get into today's trading. Okay, today we started off with a narrow range pivot range. You can see the purple lines here, very narrow. And whenever you see a narrow range pivot range, you always want to equate that with volatility. You're going to have a very volatile session unless the opening range can engulf it, okay, and then that usually nullifies the volatility, okay. So today, knowing that you're going to have a volatile session, you want to be aware and be careful, okay. So this morning we were gapping down. You can tell we were gapping down here. The first candle of the day is our opening range, and that's this gray area. And we had a shooting star pattern here on the first bar, and it looked like we were going to get selling right off the bat, but we didn't get any follow through. We didn't take out the low of that bar, and then price turned back up and approached the top of the A point. Okay, we approached the A up. Now if you'd have gotten short here at the A up on the first touch, let me bring up the 1 minute chart here so you can see a little bit better. We touched the A up. If you got short here, you're going to use a 11 tick stop, and you're also going to use a time stop of 5 minutes above the opening, above the A point as a stop. Okay, so you got two stops. One is an 11 tick stop. That gets taken out, you're done. Okay. If the 11 tick stop doesn't get taken out, then what you're waiting for is to see if they can spend 5 minutes or more above the A point, okay, to confirm it. Here you can tell that we chopped around just below it. It pushed down. So this was a nice little 2 points here, okay? And then it pushes back up. Now, when it pushes back up here, this is, a bit scary, okay? And, you're wondering if you're going to get stopped out. Well, your stop is going to be 11 ticks, okay? Or 5 minutes above the line. Well, they could only spend 2 minutes. Then it rolls over and comes all the way back down to the top of the opening range. This white line's the top of the opening range, okay? It pauses here, okay, and that's expected, okay? That's actually where you want to get out of at least half your trade, is at the top of the opening range. And that's because whenever you're above the opening range, you want to be thinking long, okay? And the top of the opening range is going to act as support, okay, until it fails, all right? So it finds support at the top of the opening range and then pushes back up. Now this second push back up here, I would call this a second attempt at the A. Now if you hadn't already faded the A here, I would not have initiated a fade here, okay, because this would be considered a second time, okay? And then price does push up to the 11 tick stop, but it doesn't go 1 tick above that. So if you're, you might have been taken out here and you might not have been, depending on where you were in the queue, okay? And then price does spend 5 minutes. So you got 1 here, 2, 3, 4, and 5 minutes above the A point. And also you're above that narrow range pivot range. So this is an A up through the pivot. Whenever you get that, Fisher would say, increase your size, step on the gas, reduce your risk, and look for a big trade. The reason that you are increasing your size and stepping on the gas is because you've got two indicators. You've got the A up and you've got the pivot range failing. These are two separate indicators, telling you the same thing. So the way that you reduce your risk, Fisher would say, is you're going to use the bottom of the pivot range as your stop, okay? And that happened within like 3 or 4 minutes after the A is confirmed. We came back down and traded below the pivot range, okay, low. That would stop you out on the A up through the pivot, and that would be a failed A up through the pivot, okay? So when we traded back below here, and this bar actually closes back below the low of the pivot range, this is a failed A up through the pivot. You could get short here, okay? Again, your stop would go 1 tick above the high of the day, all right? And then this made a nice move back down again, found support at the top of the opening range again, just for a little while, and then it failed and got back into the opening range and pushed all the way down to the other end of the opening range. Now, When it gets down here to this yellow line represents the C point down, okay? And when you have an A up, that's bullish. When you hit the B point, which Fisher's B point would be the bottom of the opening range, you get out of your bullishness and you are now neutral. When it can confirm the C down, okay, then you go bearish, okay? And so here on the C down, you would get bearish. Now, the problem with this C down today was it happened in the middle of the day. The C trades, I don't trade them a lot, but when I do, I want to see them be late in the afternoon, and that's because they work better in the afternoon because you've got more traders trapped, okay? So today, this confirmed confirmed a C down, and with this C down, again, it's like an A down. You don't want to sell in the hole. You want to wait for a bounce, okay? You want to get a bounce back up towards the bottom of the opening range so that you can define your risk, okay? So if you would have gotten short in here at the bottom of the opening range, I use a stop of a closing bar back into the opening range, and this bar right here closed back into the opening range. So this would have stopped you out on the C down. Now, if you would have gone by Fisher's rules, okay, Fisher uses the top of the opening range here as a D point for the C, okay? And if you'd have used that stop, it would have never been taken out, and you could have stayed in the short, and price rolls over and continues to go down and closes near the low of the day, okay? So here's a situation where my rules, my adjustment to Fisher's method took me out of a trade here, whereas if you'd have stuck with his rules, it would have worked for you, okay? So there's one for Mark Fisher. His rules trump my rules today. However, you know, like I said, even if you would have, you didn't want to short here once the C down confirmed, wait for a bounce, okay? Then short. If you would have shorted in here, where's your stop? Right here. This is a very small risk right here, okay? So this is very small risk trade with a big reward, okay? And that's the way you want to think. You want to think, you know, frame your trade, find out where your stop's going to be, and that stop's going to be where you're wrong, okay? So if you've got a C down and your C down is going to be wrong if you take out the high of the opening range, then a short right here is very small risk, right? So that's where you want to short. Now also, another point to point out is look at the moving average lines. They're all stacked and sloped to the downside, and you're approaching the middle line here, and that's another good place to short. Now, one thing that Fisher talks about is when the moving average fake out is what he calls it, okay? That's when price, you know, gets below here, we're in a sell, comes back, tests the middle line, and then once it closes back below the green, back below the fast move, this is a signal that the trend's going to continue right here. So that's his signal. So you could wait here. And again, where you get out if you're wrong, again, up at the top of the opening range, and then this pushed down and continued all the way down to the end of the day, okay? So I think that's going to do it for today. And, you know, today was a very interesting day, and I think we're going to possibly get into a little bit of selling here and maybe some added volatility. If you've noticed that our A point has been coming down, 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 today's stretch point was only 3.26. Whenever you get below 350, you're getting into a quiet market, okay? But today I think we added a little bit more volatility. And hopefully, you know, if you can get that volatility up a little bit, you know, I like to see the A point somewhere between 3.5 to 4 points, even 4.5 is that's a good slot to be in for the A point. So I don't like when we get into summertime trading and that A point starts to get down into the, you know, below 3 and into the 2s and stuff like that, and you get really, really slow markets. I like it. I like to have the volatility stay around. Okay, guys, that's it, and we'll talk at you later.